information.
Stock market down another 2,000.
Computer malfunction at the stock exchange.
Prices on the stock market.
The stock market's been down.
Stock exchange.
Stock market crash.
The New York Stock Exchange doesn't wait for anybody.
The stock market is not as risky as you think. And in this video today, I'm going to explain to you and show you with real-time historical footage of how likely you are to lose money over time, and it drastically goes down. A lot of people like to say the stock market or investing is gambling because whenever they see these news articles or they see the stock market plunge or have lots of volatility, they say it's unsafe or risky. Well, I'm going to tell you there's almost zero risk as long as you play the game right, and I'm going to show you how to do it today. It doesn't matter if you haven't started investing or you're an experienced investor. Watching me run these numbers for you live is going to absolutely help your risk evaluation and actually prove to you how this works in the long run to help you become a better investor and be self-aware. So let's start from day one. I'm going to be personally using the S&P 500 as our benchmark for this. This is what people mean when they say the stock market, and it's the top largest 500 companies in the United States like Apple, Tesla, Google, Microsoft. So let's say you're a brand new investor. You put your market in for one day. You just put it in. You're super excited. What is your percent chance to lose money? It is actually 46% chance. So most likely you are going to make money, but it is a coin toss for your first day as expected. As you will see in this video, more time you hold your money, the safer it will get. Next, if you hold your money for exactly 1 year, you're going to have a 25% chance to lose money, which means you're a 75% chance likely to make money. So that means in every 1 out of 4 years, the stock market goes down. And just holding your money an extra year, your chances drop of losing money to a 10%. That means you have a 90% chance to make money in the stock market if you hold your money in there for just 2 years. It is very important for you to understand that I'm using the S&P 500 as a baseline. And why I said you need to play this game right is because you need to invest in ETFs or these safe exchanges or these index funds so you don't lose money in these individual stocks. Another very important thing to note before we go on is your average return in the 1 year is going to be 8 to 10%. So if you do make money, you're probably going to be making around 8 to 10% year over year. Now that we got past the baby steps, this is where the real magic happens. So starting at 3 years, we have a below a 10% chance, around a 5 to 7% chance to lose money in the market. And this is assuming worst case scenario, stock market crash all the way down and it's still climbing back up. But realistically, we could just buy the bottom of the dip and we would increase our likelihood of taking our average buy from the top all the way from the bottom to even it out. So realistically, if we play the game right, we have even smaller percent chance. But I'm just going to use the S&P as a baseline for my example, just straight numbers. So next 5 years, you have less of a 5% chance to lose money. And then finally in 10 years, you have a 1% chance to lose money. How crazy is that? Just holding your money for 10% and assuming the average happens of 8 to 10%, you should have a 100% gain, meaning most likely you will double your money. And the average for you to double your money is about 7 years. So this is actually amazing. And starting from a magic number of 15, statistically, it is basically almost impossible to lose money from 15 years. I know it sounds like a lot, but putting your money in a regular savings or high yield savings account will not even compare to 8 or 10%, not even close. 20, 40, 50 years, it's not a matter of did you lose money or did you make money? It's a matter of counting your millions at that point. How much money did you make? Because if you did this right and you did your due diligence and you're investing in ETFs or good stocks, you will come out very profitable. One of the main reasons that somebody might say the stock market is risky, if they look at the statistical facts of a regular retail investor like me, they tend to underperform the market by 50%. But the main reason is because most retail investors are scared when the market goes down. So that means the market goes down, they take all their money out and their losses are cut and they can't make any money when the market goes back up again. As long as you keep your money invested in the stock market, in the S&P 500, you will have barely any risk in the long term. And now I'm going to share a secret tip on how you can make this even less risky for you. So let's say, for example, the stock market stays at $100 and then it crashes all the way to $50 for a 50% loss. Those regular retail investors will sell at 50%, taking their 50% losses. But we bought at 100, and now we're also going to buy at 50 at the 50% loss. So our new average price that we bought at was 75. So the market doesn't even have to go all the way up past 100 for us to break even. It just has to go up to 75. And then when we do get back to 100, we'll be making that in pure profits. Like I said, you just have to know how to play the game right. Invest in these safe ETFs for growth. Buy the dip. Invest over time. And play the game statistically like it was meant to be played. The last tip I'm going to give you guys before we clock out is to do lump sum investing. Since this is a statistically based channel, I'm going to give you the best way to put your money in the market. A lot of investors use dollar cost averaging, which means they put their money in over time, which isn't bad, but statistically lump sum, which is putting your money all in when it's available to put in all at once, wins 75% of the time. So what I personally do is with most of my money, or let's say 75%, whenever I have available to put in the stock market, the money I want to put in, I put it in all at once into an S&P or a growth ETF. And the other 25 I can keep on the side. And whenever the market dips or might crash, I can put it in and buying the dip moment, which is the perfect way for you to actually have less risk over time if you do this. So overall, the stock market is not as risky as the uneducated person thinks it is, but you, having watched this video, now know that it's not as risky as everybody thinks, and it's actually the number one or number two way to build wealth in the long term. And statistically, this is the best way to build wealth if you don't have a lot of money to start. Other big money-making things like real estate or businesses, they cost a lot to start up and have tons of risk. Well, this has almost no risk if you do it right, and you can start as little as $1 or $6 a day to become a millionaire.